Hello everyone. The RBI in its Monetary Policy Committee decision today voted in favor of a rate cut of 25 basis points, which means that the repo rate stands reduced from 6% to 5.75%. The beauty in this rate cut against the past two rate cuts that we saw was that the committee members voted for a departure from neutral to an accommodative stance. We believe, along with the rate cut, this stance change or the gear change from neutral to accommodative is clearly a trend or a trajectory in the positive direction. The bond yields have reacted favorably to this. We have seen specifically on the government bond side, yields ease off by about 5 to 10 basis points. Bond yields are trading well below the 7% mark on the 10-year benchmark government yield. We've also seen similar movements on the corporate bond side, but we expect the corporate bonds to react with a little bit of lag. What is very important to highlight on this policy is that there seems to be a focus on the growth while not compromising on the inflation. So I think at this point in time, there is a recognition of the fact that global growth is headed for a slowdown and India would not be an exception. The liquidity measures also seems to be that they seem to be committed to maintain liquidity in the banking system, though we have not really seen any explicit measures. As we speak, the banking system liquidity has moved in from a deficit region to a positive region. It is very important for the bond markets to see this trajectory of positive liquidity to continue to ensure that the bond yields are anchored at the current level. The month of May saw the political outcome come in the favor of the current ruling disposition, and I think that has given reasonable amount of confidence to the policymakers to probably take this kind of an action. Going forward, I think the bond markets will continue to focus on a couple of things, namely how much and how soon the liquidity deficit continues to get replenished by the Reserve Bank and in what form and shape. Would it be open market bond purchases? Would it be the dollar INR swaps? Or would it be a third out-of-box measure that would be adopted to restore liquidity into the banking system as and when needed? Second, there would be a lot of cues being taken on what happens on the global front, specifically the US, and if or not the policymakers in the US would actually give in to what the US bond markets are expecting, which is now suggesting that there could be rate cut by the end of 2019. It is also important for bond markets to note what are the developments on an incremental basis that are happening on the NBFC front, specifically to provide more liquidity to them. Those counts where we saw not much of talk or in the reads in terms of the monetary policy decision, I think that is what in the coming weeks or months the markets will look forward to. In terms of strategy and positioning, we believe, and we have stated this, that incrementally, given the reduction in short-term interest rates, categories such as liquid may mean less returns accruing to the investor given the short underlying nature of instruments. Therefore, as a bond market participant and a bond market investor, we have been stating for quite some time that it makes sense to extend duration, which means liquid to ultra short to short, and so on. For those willing to witness or live with volatilities, extending duration beyond short-term categories to a combination of medium-term, long duration or dynamic bond funds still would continue to be the order of the day. Bottom line, volatility will be here to stay, whether it is on the interest rate front or the credit front. It is very imperative when you are making allocations into the fixed income category, you need to be very clear about your investment horizon. If it is a 7 to 15 day money, it is no doubt that it would be the liquid category that would continue to hold appeal to you, irrespective of what the outlook on rates are. Relatively, if you have a longer maturity and a longer tenure and therefore a slightly more higher risk appetite, then it makes sense to look at the other category of funds. We remain constructive on the overall interest rates and the fact that they will continue to remain anchored in the system. We will continue to monitor cues emanating both from domestic markets as also the global markets and continue to manage portfolios on a risk-adjusted basis rather than on a pure return-only basis. We hope you remain to stay invested and keep allocating basis your risk appetite and intended horizon. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.